Over the last week, thousands of retail portfolios were wiped out in hours. Traded positions evaporated as unexpected liquidations cascaded through the system. If you found yourself trapped in these recent highs, you aren't alone. It is easy to buy into a market top when social media is flooded with narratives promising an endless climb. But the data tells a different story. The current crypto market is mispricing a series of severe macroeconomic headwinds. Many traders rely blindly on the traditional 4-year Bitcoin cycle. However, historical crypto patterns lose their predictive power when they move in direct opposition to Federal Reserve policy and a global contraction in liquidity. Today, we are going to map out the quantitative model that suggests this recent price action is a structural trap, designed to use retail buyers as exit liquidity. Ignoring the collision between these macroeconomic realities and crypto cycles leads to the systemic destruction of your portfolio. This is the business cycle formula. We calculate this by taking the S&P 500 divided by the unemployment rate squared, then multiplying by U.S. interest rates and the inflation rate, and finally normalizing it by the M2 money supply. This formula tracks the overall health of the economy, accurately identifying the beginning and the end of major expansions over the last century. Right now, the curve is trending downward. When it crosses this lower threshold, we enter a late-stage business cycle environment, a period defined by a contracting economy and restrictive capital. To understand why this contraction is occurring, we have to look at the behavior of energy prices. In an early business cycle, rising oil prices indicate healthy consumer demand and industrial growth. It means businesses are expanding and people are consuming more. But in a late cycle, a spike in oil is a bearish signal. It represents a supply-side shock, often driven by geopolitical conflict, rather than an increase in actual market demand. This geopolitical supply constraint ripples from international production into the daily reality of everyday consumers. When people are forced to pay these high prices at the gas pump, their disposable income vanishes. They are no longer taking that extra cash and putting it into speculative assets. When the base consumer is drained by basic energy costs, the systemic liquidity required to sustain a broad crypto bull run is essentially eradicated. With energy prices choking out retail capital, the Federal Reserve is now forced to look at their primary mandate, protecting the U.S. labor market. The underlying metrics are showing weakness. If you track total job openings across the broader economy, the trend has been pointing downward for months. Look at this line chart tracking U.S. employment level growth. The year-over-year additions have flatlined, dropping to a low of 156,000 new jobs. Historically, severe recessions are triggered the moment the specific employment metric crosses the zero line into negative territory. Under normal circumstances, the Federal Reserve's playbook is to aggressively cut interest rates to stimulate the economy and save a dying labor market. But a second opposing force is paralyzing their ability to act. The Producer Price Index, or PPI, which measures average changes in prices received by domestic producers, is coming in hot. The market consensus expected the year-over-year PPI to print at 2.9%. Instead, it arrived at 3.4%. Those late-cycle oil spikes we mapped out earlier are the direct cause of this sticky, elevated inflation. The institutional market immediately recognized this data.
As a result, expectations for the next rate cut have been delayed, with some probabilities pushing relief out entirely for the next couple of years. Even Fed Chairman Jerome Powell knows the reality of this bind. During the recent FOMC press conference, he acknowledged the weakness in the labor market before quickly correcting himself. The Federal Reserve faces a structural impasse. They cannot cut rates to save jobs without risking a resurgence in energy inflation, a scenario that leaves crypto markets starved of the liquidity they expect. Understanding macroeconomic theory is important, but translating that theory into actionable market execution is what actually preserves your wealth. When facing these specific macro fakeouts, a defensive trading strategy involves using targeted short positions to hedge your spot holdings. We use Bingax as our exclusive platform to execute these hedges. It provides the necessary liquidity and stability during periods of extreme market volatility. Viewers who utilize the official partnership link in the description receive specific onboarding bonuses and direct access privileges. Ultimately, possessing the correct macro thesis is useless if you lack a reliable execution platform to protect your capital during the breakdown. Let's take this macroeconomic impasse and overlay it directly onto historical Bitcoin price action. When liquidity dries up, Bitcoin falls victim to the midterm year curse. The pattern is deceptive. Traditionally, Bitcoin experiences a counter-trend pump precisely in the month of March, trapping traders who mistake it for a new bull run. This composite chart isolates 2014, 2018, and 2022. Notice how each Q1 price peak inevitably leads to a cascading breakdown as we enter the illiquid summer months. The loudest voices in the market point to a strict 4-year cycle, ignoring the underlying environment. Trusting that cycle without macro context is dangerous.
If you want to understand the current market structure, look closely at the double-top fractal from 2021. It serves as an architectural blueprint for what is happening right now. The first phase of this fractal is a rapid rally to sweep the prior high. It immediately fails to hold the support band, rejecting downward to sweep the absolute lows. Overlaying the current year's price action directly on top, their trajectories track identically. This technical rejection aligns with the Federal Reserve's Summary of Economic Projections, also known as the SEP, which outlines the committee's outlook on future interest rates. The latest SEP confirms that no rate cuts are currently imminent. The external capital required to push prices higher is not entering the market. Because this collision of data prevents new liquidity from entering the system, this structural midterm fractal points toward a severe downward correction. The data is clear. A late-stage macroeconomic contraction is currently neutralizing the historical crypto 4-year cycle. The golden rule for this quarter is simple: never fight the Federal Reserve's restrictive policy, and treat all Q1 price highs as dangerous liquidity traps. While the mainstream timeline relies on hope, smart money is securing exits based on verifiable data. Secure your macro advantage by subscribing to the channel and joining our premium group at intothecryptoverse.com for unfiltered, real-time analytics. But accurately diagnosing Bitcoin's macro state is only half the battle for survival. Mismanaging your risk exposure to highly volatile altcoins during this specific breakdown phase will wipe the remainder of your portfolio. Click the video on your screen to see exactly how these altcoin traps operate.